Hi, my name's Griffin Bridgers. Today's video is about investment partnerships. Now that can have many definitions, both functionally and from a tax perspective. But what we're concerned with today is how that's defined from a tax perspective. In particular, we're going to dive into Code Section 721 and 351 and look at how those can affect a usual assumption that you can fund a partnership without incurring any income tax, especially when securities portfolios are involved. So if you've dealt with this issue, this will be a great video for you. And if you've been curious about this issue, there may be some surprises peppered in. Now, before we get started, I want to remind you this presentation is not intended to substitute for legal or tax advice and is provided for educational purposes only. So, I've talked about this in some of my prior videos, and more info and formal registration is coming, but I plan to launch my own estate planning and tax symposium, tentatively to be called the Western Wealth Transfer and Tax Symposium. So I plan to hold it online November 8th and 9th of 2023, and probably offer around 11 continuing education hours. So stay tuned for more. Reach out if you're interested, and once I get some kind of formal registration opened up, I will start to publish that on these videos and on my newsletter, which you can find at griffinbridgers.substack.com. Jumping into the substance of our discussion today, whenever we have what we call a tax partnership, which is really an LLC or a partnership under state law, or maybe even a joint venture that by default is taxed as a pass-through type of partnership entity under subchapter K of the Internal Revenue Code, we usually have what's known as a tax-neutral exchange when we put property in exchange for a partnership interest. And that's provided under Code Section 721, which generally says that no gain is recognized on a transfer of property in exchange for a partnership interest. Now, recognized is a loaded term, and we're going to see that that loaded term factors into what we're looking at today. And there's one big exception to this general non-recognition rule, and that governs what we're going to call investment partnerships, which isn't a formal term under the tax code, but is really an offshoot of another formal term called an investment company. So, as we get into this, here's a quick visual of what type of exchange we're looking at in kind of the context of the parties involved. We have a contributor who's putting assets into a tax partnership and then getting back a partnership interest. Now, that doesn't have to be a partnership under state law. It could be an LLC or a joint venture, like I said, but either way, you're getting back some form of equity interest in the tax partnership to which a contribution is being made. So, there's a general rule under the tax code that looks at exchanges of property as being like a sale. However, when there is an exchange of non-cash property for non-cash property, or even cash for other forms of property, there are some situations like this where it won't be treated as a taxable exchange. So, in that vein, when we look at this one exception to that general non-recognition rule, it helps to consider the bigger picture. And there's a couple key points we need to think about in terms of partnership strategy and what the tax code's trying to accomplish. And a tax partnership can be a great vehicle for the deferral of gain recognition, or even potentially trying to spread pre-contribution gain amongst other partners. And the way we get there and why that happens is because of the carryover basis rules. Carryover basis on that contribution to the partnership is preserved on both sides. So both parties here are going to end up with a carryover basis, one for contributed property and one for newly created property in the form of the partnership interest. So to get granular on that, when property is put into the partnership gets the contributor's carryover basis in that contributed property. That's usually thought of as inside basis. And then the contributor gets back a partnership interest, and that partnership interest is assigned the same carryover basis that the contributed assets have. And that basis is often thought of as outside basis. Now, that's a very, very general way of looking at this, and there are several little exceptions and tweaks to that. But there's one key point here where, to prevent abuse and keep the partner from spreading out gain or shifting gain to the other partners, there are rules, especially looking at the contributing partner's gain through Code Section 704C, 737, and 707, to name a handful. So those can kick in, especially in a situation where you're putting in assets and trying to diversify your investments and potentially diversify your gain. You may not be able to, but to get there first, there's a situation where we have to look at, do we even have deferred gain to begin with when we put property into the partnership? And there's a little known code section, 721B, which we must avoid if we want to just simply defer our gain on the initial contribution to the partnership. So what does 721B say? Well, it says that subsection A, i.e. 721A, shall not apply to gain realized on the transfer of property to a partnership which would be treated as an investment company within the meaning of Code Section 351 if the partnership were incorporated. So I mentioned that recognition is a loaded term, so the context here in tax is that gain can be realized in an exchange, but there's no tax unless gain is recognized. That's a synergy, that the whole may be worth more than the parts, and your partnership interest could end up being worth more proportionally than the assets you put in. So essentially, what this code section does is recognizing that gain is realized, but it's not technically recognized for 721 purposes, except in this narrow circumstance where the partnership could potentially be an investment company if it were incorporated. So what does that mean, and what is an investment company? So the threshold inquiry here is a hypothetical situation where incorporation of the partnership would cause it to be treated as an investment company under Code Section 351. So really, incorporation in this context is going to be a conversion from a tax partnership to a tax corporation. So as I mentioned, there's a split between the tax form and the state law form of an entity. So we could still have, for example, a partnership or LLC, which makes a check-the-box election to be taxed as an association, which would be incorporation for 351 purposes, or we could even have an actual formal state law conversion of a partnership to a corporation where partnership interests are being exchanged for new stock. But in either case, we have to dig through that hypothetical situation and look at, would the partnership after that hypothetical incorporation be treated as an investment company? And to get guidance on how that investment company term is defined, we must then go to Code Section 351E1 as supplemented by Treasury Regulation 1.351-1C. So before we dive into those, it helps to know the why behind everything and kind of the lay of the land, so you can understand what the outcome is that we're trying to avoid and what boundaries we might be able to push in that outcome. So the common theme beyond that deferral of gain potentially you get through a partnership is the second layer of diversification. The fact that you can put property into a partnership without recognition of gain gives you the ability to possibly diversify your investments with a lot of other people. So a lot of people could put in different types of assets into a partnership and defer their gain and spread it out amongst each other, which, if you were to try to accomplish individually, would mean that you'd have to sell securities positions, for example, and then reinvest the proceeds. So if you were to hold individually and sell, you'd have to recognize some gain for appreciated positions. Whereas if you were to put assets into a partnership, you may be able to somewhat avoid that outcome. So the question here is whether you can avoid some of that gain that you'd have to self-impose to diversify your portfolio by combining your investments with somebody else's through a partnership, and then reaping the common economic return of that now diversified partnership portfolio. So if you understand that, that's the issue that the IRS is trying to shore up here through the investment partnership rules, especially with respect to marketable securities portfolios. However, what we're going to find out is that the big concern here isn't necessarily penalizing those who already have a diversified portfolio. It's more looking at situations where each contributor has one or maybe even up to 5 highly concentrated positions and then weighing those amongst all contributors. So that's where you achieve true diversification, is when each contributor is not diversified to begin with. So that's the common thread that a lot of people get wrong on this investment partnership rule and investment company rule, and looking at how it is defined. So let's jump into this bigger question of, before we dive into that, why is diversification a concern with a C corporation? Because after all, the investment company rule and the investment partnership rule looks at a hypothetical incorporation. Well, it helps to do a little bit of a history lesson going back, because right now we have a low flat corporate tax of 21% under the Tax Cuts and Jobs Act, but that wasn't always the case. There used to be tiered corporate rates, with the highest rate being at 35%. So in the past, you could ride up the brackets and lower your taxes through diversification. And even though there's a shareholder level dividend tax potentially, you could still leverage that, for example, through a corporate income tax that had a 15% bracket that applied, so long as the return on the diversified portfolio after everybody had put in their assets did not exceed $50,000. And then that rate jumped up to 25% for corporate income from the diversified portfolio between $50,000 and $75,000. So this, like with partnerships, was an anti-diversification measure for investment companies that also treated the exchange of assets for stock as a gain recognition event if there's concentration that results in diversification after the contribution of assets to the corporation in exchange for stock. So knowing that background, that helps us more to define what an investment company might be. So an investment company, in this context, is going to be a corporation, or really a partnership, as we're looking at, that has an asset mix of over 80% marketable securities by value that are held for investment. So we'll get into that in a minute, but we can't stop just at the asset mix. This is where a lot of people get this wrong, is they look just at the asset mix and assume, oh, we have over 80% of by value of marketable securities, so this is an investment partnership and we have to pump the brakes. But there's a second layer we have to look at, and that layer is whether that contribution to the corporation or partnership results in a diversification of the contributor's interest directly or indirectly. So this is a inquiry we don't look at as a whole with respect to the entity. We look at this on a per contributor basis. So you have to look at each contributor in isolation and figure out whether they have achieved diversification of their interest directly or indirectly by their contribution of marketable securities for equity. And that's the point that is often missed. And there's luckily some pretty bright line tools within the Treasury regulations under 351 to figure out exactly what diversification means in this scenario. Now, we're going to really treat this as a surface level analysis, because where the complication comes up here is getting into the various rules and exceptions on what exactly constitutes a security or marketable security. So in most cases, I'm going to assume you're dealing with portfolios of publicly traded stock and not alternate investments or anything like that. But jumping back into this, to add on to our analysis of this non-recognition transaction and how that non-recognition might be taken away in the case of an investment company or investment partnership. Again, we have assets going into the partnership in exchange for a partnership interest, but we then look to Another question, are the contributors' interests directly or indirectly diversified? And are the post-contribution asset mix of the partnership or corporation comprised of over 80% marketable securities that are held for investment? And that's the other important piece. The securities have to be held for investment. So for example, if you're a broker, securities are being held for sale and not necessarily for investment, and thus are more in the nature of inventory, which takes you out of this rule, for example. And also, there's a look-through rule here as well. It may seem intuitive that maybe you could stuff securities into like a subsidiary corporation or partnership, but that look-through rule keeps you from doing that. To avoid this, there is that look-through rule that says that securities of any subsidiary or partnership are treated as if they're owned directly by the corporation or partnership to which the contribution in exchange for equity is being made. So that brings us back to the core question in all of this is going to be how we define and analyze this question of diversification of the contributor's assets or interests in this transaction. So there's really, when you look at the regulations, about 4 different types of safe harbors that we can shoehorn ourselves into, and they tend to be a little broader than you might think at first glance. For one, if there's only one shareholder, there's not diversification for obvious reasons. You can only get diversification if 2 or more people are putting in different assets, which will be another key point we have to look at in a minute. And ironically here, while you can have one shareholder in a corporation, you can't have one partner in a tax partnership. If there's just one equity owner in an entity that is called a quote-unquote partnership, you may not even have a partnership at the state level. And even if you do, typically you need 2 separate and distinct taxpayers for Code Section 721 to even apply to begin with. Otherwise, you simply have a disregarded entity. Now, in the family and estate planning context, this often comes up in a situation where spouses are putting property into a tax partnership. So, are spouses treated as separate and independent taxpayers? Usually they are, even if filing jointly, but there is some nuance to that. In some cases, if community property is contributed, the spouses may have the option to either treat the partnership as a disregarded entity or treat it as a tax law partnership simply by the choice of whether or not to file a 1065 every year for the partnership. I'll have a later video on that point coming down the pike, but let's assume we have a situation where spouses are putting in assets and are treated as separate and distinct taxpayers for partnership formation purposes. That brings us to another point where with that joint or community property or whatever, it's usually the case that you don't necessarily have separate portfolios among the spouses that are being pooled. And even if you do, they could simply just add the other to as a joint tenant onto those accounts, which wouldn't be a gift, and then put those assets in. And that brings us to our next safe harbor, which is that if the contributed assets are identical, there's no diversification. Again, for obvious reasons. The only way you achieve diversification is by having different assets from the other contributors. So if spouses have a joint account or have substantially similar accounts, they can take us out of the investment partnership company rule when those contributions are identical, i.e. they're each putting in their 1/2 interest in the same diversified portfolio. And possibly a loophole to this too, potentially, is that even if spouses don't have a diversified portfolio, if they each have separate portfolios, they could appoint the other as a joint owner or joint tenant on those accounts if not already treated so under state law, and thus achieve that identical asset type of mix and then put those assets into the partnership. So those are the relatively easy safe harbors, but that brings us to another couple types of safe harbors that are a little more complex, but still add some simplicity, I think, to this analysis when we dive into them in a little bit greater detail. The next safe harbor is that even if there are non-identical assets, the non-identical ones are insignificant when you take them in the aggregate among all assets transferred. Now, there's no precise number for this, but there's one example in the regs that uses approximately 2% as a figure, which wouldn't necessarily be a safe harbor, but kind of shows that level of insignificance. And in that situation, you had two contributors putting in identical assets worth $10,000, and then a third putting in a non-identical asset worth only $200. So that's where we come up with that 2% figure as weighed against the identical assets, not against the whole of what's been put in. However, where this kind of goes off the rails is that you have to look at all assets transferred. Now remember, going back, that I mentioned that this analysis of diversification is on a contributor by contributor basis. You're only looking at individual contributors in isolation. However, number of contributors matters as well when we look at this level of significance of non-identical assets. So even if you had each contributor who individually puts in an amount that would be insignificant if looked at in isolation, you also have to consider the significance of diversification in the aggregate when looking at all contributors there. So that's the second example in the regs where you have a number, I think 50 different people putting in $200 of assets. And at that point, it does become significant in terms of diversification, even though each contribution is relatively insignificant when looked at in comparison to the whole. And that brings us now finally to the situation we're going to find ourselves in most of the time when we're looking at this, and it's going to be a little bit surprising, and that exception is where each transferor transfers an already diversified portfolio of stock and securities. So again, I go back to my point that what the IRS is concerned with here is a situation where you have concentrated positions that are then getting diversified after the contribution to the partnership or corporation. But in this context, if you already have a good level of diversification, then there's going to be no investment company and no recognition event on the contribution of securities for equity in the partnership. So the reason this is a safe harbor, again, relates to that level of diversification that is achieved. So again, we have to look at each contributor who's subject to 721 or 351, and each has to be putting in really a diversified portfolio. And while this is an individual analysis, usually in diversification, again, we have a test where we have to weigh in the aggregate the total value of assets that have been put in when compared to each contributor's individual contribution. So the regs reference code section 368A2F in terms of the test to determine whether we have a quote-unquote safe harbor diversified portfolio. So traditionally, this code section that's cited had us look at reorganization between investment companies, because 368 really deals with tax-free reorgs, exchanges of securities in old corp for new corp and vice versa, and whether those are non-recognition events between corporations and unrelated parties. So that code section weighed whether there's diversification through a reorganization where investment companies are being combined to determine whether that same non-recognition treatment can be obtained, and that is now extended to 351 and technically 721 in this safe harbor diversified portfolio test. So we're going to examine the asset mix among who we're going to come to know as single issuers, or really securities positions within the portfolio itself. So here's the general ratio we're going to use with respect to each contributed portfolio. Our numerator is going to be the stock or securities from 1 or 5 issuers. Those are 2 separate tests we're going to look at, but in either case, the denominator, that amount is going to be over, is the total value of the corporate or partnership assets after contribution, with some tweaks we'll look at a little bit later on. So there's 2 tests within this, as you can imagine, the single issuer test and the 5 issuer test. And essentially, what those do as a result is allow highly diversified portfolios that are not concentrated in any particular possession or set of 5 positions to pass muster here potentially. So there's a threshold for each test. One, we have the single issuer test, where we're going to look at the stock or securities from one issuer over the post-contribution total value of corporate or partnership assets. So if no more than 25% of the stock or securities of a single issuer make up all the assets, then that test will be passed. So essentially, what you have to do is look at your largest position by value within the contributed portfolio and then compare that to the total value post-contribution. And if you have a 1/4 ratio or less, you will pass this test. But you can't just stop here. You then have to move on to the 5 issuer test, where now you take your 5 largest position by value within the contributed portfolio and you weigh those against, again, the total value of corporate or partnership assets post contribution. So using this test, if no more than 50% of the stock or securities in total of 5 different issuers makes up all of the assets, you will pass this test. So if you look at your top 5 securities positions, add those up as your numerator, then divide by the total post-contribution value of assets. If your fraction is 1/2 or less, you will pass this test as well. So a couple ways to look at what the true definition of diversification and contribution is, but really it's going to be a matter of 1 to 5 positions and not a more diversified portfolio beyond that. So technically, if you look at this, if you had an equal position in each holding, then 10 positions or more equally really kind of lead you to this safe harbor diversified portfolio. So again, there's some tweaks to this we need to consider, especially in our denominator of what's actually being put in. For one, we're not going to include government securities in the numerator, but they are included in the denominator. And cash and receivables are excluded from the denominator as well. However, there are rules that say if you acquire government securities for purposes of meeting either or both tests, then you're going to probably fail that test and you're going to be forced to include government securities in the numerator as well. So for example, if you had a portfolio that was not diversified under this rule and you bought a bunch of municipal bonds and did so solely for purposes of trying to pass this test, which there's no bright line rule on how far apart those transactions have to be, then you can run the risk that you'll fail this. Also, if you try to stuff the partnership or corporation with cash for purposes of increasing your denominator, that's not going to work because the cash and receivables are excluded from the denominator as well. So essentially, you can't stuff with cash or receivables or municipal bonds to try to achieve and pass the 25% and 50% test. So that is, hopefully, a confusing subject, investment companies and investment partnerships in a nutshell. I know there's a lot to take in, but if you remember those 4 general safe harbors weighed against the general rules of diversification and gain deferral, then you'll understand the name of the game here looking at diversification and the fact that simply having an asset mix of over 80% marketable securities held for investment is not enough to fail here. So essentially, you're going to have multiple contributors to begin with, either in separate or multiple transactions, who have non-identical assets or portfolios of marketable securities, which will be held for investment. Now, there could already be assets in the partnership and you have a new contributor coming in, and in that case, you'd have to look at diversification with respect to them as well. And that's a little more nuanced than we have time to look at today, but I want you to remember that this is done on an individual basis, contributor by contributor. And this focuses on gain to the person contributing a portfolio of securities in exchange for a partnership interest. This does not affect the partnership or the corporation. It doesn't trigger, for example, corporate level gain. However, the partnership or corporation will get a stepped up basis on the inside basis of assets to the extent the contributor recognizes gain on that contribution if you run afoul of this rule. And remember too, that this is a situation where you're only punishing portfolios with significant concentrated positions as analyzed after the contribution. We're not really looking at diversification of already highly diversified portfolios to begin with. So that's something to think of, but that's not the end of the road. You still have to consider that once you get over the hump and have non-recognition treatment due to not having an investment partnership or an investment company, you still have to keep in mind your restrictions on spreading out any of an individual's pre-contribution gain under Code Sections 704, 707, and 737. As always, if you're a tax or estate planning practitioner and you have any questions or topic suggestions, you can email those to me at griffin.bridgers@gmail.com with the caveat that I cannot give tax or legal advice in response to your questions. And if you enjoy this content or this topic, and you'd like to have me as a speaker at your upcoming event, whether it's a estate planning council, bar association, conference, or in-house program, feel free to reach out at that email address as well. But I thank you for listening to this video, and I look forward to seeing you in my future content.